What if you had $100,000 to invest but only one shot to get it right? Would you choose the popular VOO, known for long-term growth, or go with SCHD, the dividend-paying powerhouse? On the surface, they look similar, but under the hood, these two ETFs follow completely different paths. And the gap in results after 30 years will blow your mind. In this video, we're breaking it all down. Real numbers, real results, and the shocking trade-off between growing your portfolio versus collecting big monthly payouts. You'll see how each performs in bull and bear markets, compare dividends side by side, and find out which ETF actually gets you closer to millionaire status. Stick with me to the end, because this isn't just about returns, it's about choosing the path that fits your future best. Ready to find out which one wins? Let's dive in. We all know money keeps things moving, but smart investing is what actually grows it. Putting a large amount like $100,000 into the right place can feel like trying to crack a tough code. Two of the most talked about funds in the market today are SCHD and VOO. Even though they're both known as ETFs, short for exchange traded funds, they're built for different goals. Starting with VOO, this ETF was created to match the S&P 500. Basically, the top 500 biggest companies in the US. When you put your money into VOO, you're basically buying a slice of the entire US stock market. VOO follows a hands-off strategy. It doesn't try to beat the market, it simply mirrors it. One of its biggest strengths is its ultra-low cost, just 0.03%. That means more of your cash stays invested and has more room to grow. Inside VOO, you'll find big names like Apple, Microsoft, Amazon, and Google. It also spreads your money across different sectors like tech, healthcare, banking, and consumer spending. That mix helps lower your risk while aiming for long-term growth. VOO has become a favorite for many because of its steady track record and ability to build wealth over time. Now let's talk about SCHD. This ETF takes a slightly different route. Instead of following the entire market, SCHD picks companies that have a strong history of paying out regular dividends. SCHD tracks an index that focuses on high-quality businesses that not only pay dividends, but increase them over time. So if you're someone looking for reliable income and solid growth, SCHD might be the better fit. SCHD is also budget-friendly, with a cost of just 0.06%. That's slightly more than VOO's fee, but still one of the lowest around. What really sets SCHD apart is its strategy. It targets strong, stable businesses that not only pay regular dividends, but also keep increasing those payouts year after year. Now let's compare how SCHD and VOO have actually performed. VOO tracks the S&P 500, which means it reflects the performance of the biggest companies in America. When the economy is growing, VOO often sees strong gains, because those big companies tend to thrive in good times. Over the last 10 years, VOO has earned an average return of around 12.74% per year, closely matching the US market's growth. SCHD takes a different route by focusing on companies that reward investors with steady dividend payments, while still aiming for growth. While SCHD might not grow as fast as VOO when the market is booming, it shines when things get rough. Why? Because dividends help cushion the blow when stock prices fall. Over the past decade, SCHD's delivered a yearly average of about 11.45%, just slightly behind VOO, but with more dependable income along the way. VOO usually leads during bull markets because of its heavy focus on fast-growing companies. But in downturns, those same stocks can drop fast. SCHD, on the other hand, holds more reliable, proven companies. These businesses often keep paying dividends even in tough times, giving you a stream of income even when markets are falling. And get this, so far this year, SCHD is up 2.67%. while VOO is down minus 2.66%. That shows SCHD is holding up better in today's environment. Next up, we'll break down the mindset between both funds and how their strategies align with different investor goals. There are different styles of investing, but two of the most popular are chasing fast growth and earning regular payouts. Each path brings its own rewards, and understanding how they work helps investors decide between ETFs like VOO and SCHD, which reflect these two methods. Growth-focused investing is all about companies expected to grow quicker than others. These firms usually put their profits back into building new products, buying other businesses, or entering new markets, rather than paying out to shareholders. The aim is long-term gain, as stock values climb with business success. VOO fits this mold by tracking the S&P 500, a list of 500 major US corporations, many of which are fast movers in tech, medicine, and everyday products. Choosing VOO means betting on the future success of the country's biggest players. Income-focused investing, on the flip side, favors firms that send out part of their earnings as cash to investors. This plan is often seen as safer, offering steady income whether the market is up or down. These firms are usually well-run, long-standing, and less likely to swing wildly in price. SCHD matches this mindset. It holds US companies with strong histories of paying and growing their dividends. Now let's compare costs. VOO charges an incredibly small yearly fee of 0.03%. That means with $10,000 invested, only $3 goes toward fund management. That low cost helps more of your money stay invested and working. SCHD's yearly fee is slightly higher, 0.06% or $6 on a $10,000 investment. Though it's double VOO's cost, it's still a bargain compared to most ETFs. But SCHD brings something different to the table: steady payouts. VOO pays about 0.98% in dividends, offering a small cash return alongside its potential for growth. On the other hand, SCHD provides a much higher income return, offering a dividend yield around 3.74%. This reflects its focus on companies with a strong history of paying out regular cash to investors. For those who want steady earnings from their investments, this higher payout can be very appealing. Now let's talk about how risky these two funds are. To understand their risk levels, we need to look at two things: price movement and industry mix. Price movement, or volatility, shows how much an investment's value goes up and down. Bigger swings mean higher risk, while smaller shifts suggest more stability. VOO, which tracks the full S&P 500, shows moderate ups and downs. That's because it spreads your money across many big companies, which helps smooth out the bumps. SCHD, on the flip side, sticks with solid dividend-paying companies, usually older, more stable businesses. This makes SCHD less bumpy than VOO. Its steady focus on strong firms helps keep prices from swinging too much. Next, let's talk about sector mix, or how each fund spreads your money across industries. VOO covers almost every major business type, from tech to shopping to finance. This broad spread lowers the risk if one sector starts to fall. SCHD is more focused because it's built around dividends. It leans into industries that pay out often, like utilities and household products. These groups are usually more dependable, especially during uncertain markets. Now for the exciting part: a side-by-side growth look. Let's say Josh puts his money into SCHD. After 1 year, his investment grows to $111,330. A nice start. In 10 years, that amount jumps to $307,921, about triple his original investment. By year 20, it shoots up to $1,091,894, now paying him $61,354 a year in dividends. But here's where it really takes off. After 30 years, Josh's original investment grows into a huge $4,703,800. That's a massive $362,479 in yearly payouts, or about $30,207 each month, just from dividends. Now let's switch gears and look at VOO's outcome. After 1 year, Josh's VOO investment grows to $112,690. 10 years in, it climbs to $332,200. By year 20, the total reaches $1,093,000. And after 30 years, his account grows to $3,602,146. But here's the difference. VOO is built for growth, not income. So while the final amount is bigger, the cash payouts are much smaller. At the 30-year point, Josh receives around $42,505 per year in dividends. That's roughly $3,542 per month. So, what's the final takeaway? VOO equals larger balance, lower income. SCHD equals slower balance growth, higher income from dividends. So what's your priority? Growing your total wealth or generating steady monthly income? Share your thoughts down below. And if this helped you, give it a thumbs up, subscribe, and share for more real talk on building wealth the smart way. Here's to your investing success. Profitable investing.